I think in 2026, there's going to be likely a more dovish Fed. And that dovish Fed will allow business confidence to recover. So the ISM, I think, recovers back above 50. And that's going to be a tailwind for traditional sectors like industrials, energy, and basic materials. So I think those are sort of three groups that should do better in 2026 than 2025.
The conversation begins with a simple but important question. Is the Santa rally a real phenomenon or just a catchy Wall Street phrase? According to Tom Lee, the Santa rally is absolutely real, and it's backed by decades of historical data. The Stock Trader's Almanac has shown consistently that the period spanning roughly the last week of the year through the first few trading days of January tends to deliver positive returns. At first glance, this seems counterintuitive. One might assume that investors would sell stocks at year-end to lock in gains, donate to charity, or cover expenses. In theory, that should create downward pressure on prices. But in practice, the opposite often happens.
Just tell me something. This Santa rally, is it a thing, like a fake virtual thing, or is there a fundamental thing behind it?
I think there's actual real stats behind it. The Stock Trader's Almanac, the Hirschfeld guys actually have shown that this is a good period between basically the 1 week before the end of the year and the first few days.
But why is it? In other words, I always thought like people around this time are maybe selling stocks to give money to charity, pay bills, those sort of things. I would think there would be downward pressure on the stock market at the end of the year. And by the way, especially on a good year, trying to lock in gains so it's in the calendar for the records.
Yeah. I mean, I could say that I can see window dressing playing a role into year end. Professional money managers want their winners to look good, so they bid them up into the end of the year. And then the first part of the new year, I think, makes sense because that's when people allocate into asset classes. So there's money going into stocks in the beginning of the year.
That's the first couple parts here. I'm an anti-technical person, Kelly.
You don't like the chart stuff.
I don't like the chart stuff. I'm a fundamental guy, and I want to know if there's fundamental stuff. That was the thing. Tom, let's talk about which areas you think for the new year might be areas that are not well covered and maybe ones that are a little off the radar, the sort of, I don't know, the headwind, or tailwind, tail risk things that are out there right now.
Yes, I think in 2026, there's going to be likely a more dovish Fed. And that dovish Fed will allow business confidence to recover. So the ISM, I think, recovers back above 50. And that's going to be a tailwind for traditional sectors like industrials, energy, and basic materials. So I think those are sort of three groups that should do better in 2026 than 2025. But then there's also, I think, some tailwinds building for the financial services, which you guys mentioned are doing well, which is that financial services companies are really big beneficiaries of AI, and they're big beneficiaries of using blockchain technology. Both will allow them to reduce their employee intensity of their business. And so I think the large tech-forward banks are going to start to see margin expansion and trade more like tech stocks in the future. Wow. And that's why, the JP Morgans and the Goldmans could actually be the next Mag 7.
Can I just put a footnote or a footnote question on that? What about the deregulation part? Mickey Bowman over at the Fed has been very busy trying to make it easier for banks relative to regulations. Is that part of your outlook as well with the banks?
Well, that would be a very big tailwind, too. As you know, banks have been strangulated, especially post-GFC, and so it's removing some restrictions would be helpful, as long as you don't remove safe guardrails.
I've seen the market this year, Kelly, trade a little bit on some of the deregulation news. It wasn't something, as the year went on, it got to be more serious, and the idea that they were going to be reducing.
Because I don't read the breadcrumbs carefully.
Oh, God, it's so miserable.
But it's...
I hate covering bank regulation.
It's not like you wake up and someone goes, oh, this earnings report came out, or you wake up and I'll read an analyst note that says, yesterday in a hearing, this person indicated this, and so it's hard for me sometimes to draw a straight line.
You're so clever about that, because that's kind of the way it happens. It drops in a hearing, it's discussed by a Fed official in a speech, and then it's proposed, and then there's a 60-day comment period, and then they adopt it.
Right. And then
so between and there, it could be like 9 months or a year, and I'm not sure when, but I've seen some of the actual adoption things move some of the stocks in a way that seems to be what Tom is talking about, this idea of thinking about banks having to hold somewhat less capital as the year goes by, especially, by the way, interestingly, I don't know, you went to the regional banks, that they're an area that may benefit more than the larger banks.
Yeah, regional banks, I think, are part of the reason we like small caps, because as interest rates decline and as business activity picks up and potentially M&A pick up, this really plays into the favor of regional banks.
Tom, it seems like you're describing a year next year that could have strong growth but also low interest rates. Are those two things at odds with each other and in tension?
You know, I'd say, I know when people talk about low rates, it depends if they're looking at, you know, long rates, short rates, or even, you know, usable rates. But I do think next year is a year where parts of the economy that have been suffering from high monetary policy rates may actually do better.
Let's go to the real income chart next. And I'm still within my macro minute here. Oh, they're so good in the back there. Ugh.
Wow.
Doesn't look so good.
Face plant.
And now let's look at the difference between the two, which is the savings rate. And that's how we do math on national television. And there's the savings rate coming down. Suggests, Tom, some pressure there for the consumer. You can't keep going with incomes being flat, adjusted for inflation, and spending being higher because something's got to give. What's your take on those three charts right there?
Well, I mean, I think you're hitting a key point, which is inflation hopefully is tamer next year. And I think that that's going to be
And at a constant wage growth, that means incomes would be higher.
Yes.
Real basis, right?
That's right. And in terms of spending, I didn't realize that there was such a gap the last 2 quarters. Is that
it's the last quarter especially, yeah.
Yeah. But, you know, in some ways I can see consumers, you know, next year there's the wealth effect from stocks.
And the tax refunds as well.
Yeah, so
could help.
Yeah, so I don't spend that much time thinking about savings rates for consumers, but I think leverage is still not too high for consumers, so I think there's still room for the consumer to be healthy.
Yeah, so you see a good year for the market.
Yeah.
I think we've rarely had more than 3 years of double-digit gains. Sam Stovall was saying last hour, but you know we have had a 5-year run of them, and it was in the 90s when we were having something called the internet, and here we are in the AI boom. So I don't know how lofty my expectations should be about what this market can achieve now, or if the fact that I'm even asking if we could have a run that strong means sentiment is too one-sided and we're all due for some kind of correction. Yeah,
I mean, I think as 2025 comes to a close and the market's up 18, I think we have to remember that this was a very difficult year because from February to April we had a bear market. And we've had 7 corrections of more than 3% this year. So as much as this is like an up 18% year, it was a year of a bear market and then a recovery. So I think next year probably feels that way too, that it could have a replay where there's a very big decline and a recovery. But since 1928, there have been 12 large markets where 3 years of 20% gains have been realized. And in the 4th year, half the time, the market does better. So there's equal odds that we could actually do better than 20%.
Tom, we're out of time, but real quick, your biggest risk to this whole lovely forecast?
Well, I think that complacency still is the biggest risk. You know, that we are underestimating risk, and that's watching the VIX. But, you know, my clients are pretty cautious, so I think the good news is people aren't that complacent.
With markets already up significantly, skepticism is natural. Historically, it's rare to see more than 3 consecutive years of double-digit gains. But Lee points out that there are exceptions, most notably the 1990s during the internet boom. Today's parallel is artificial intelligence. Since 1928, there have been 12 instances where markets posted 3 years of 20% gains. In the 4th year, markets were higher about half the time. That means the odds are roughly even that markets could deliver another strong year. However, Lee cautions that volatility is likely. Just as 2025 experienced multiple corrections and even a bear market earlier in the year, 2026 could also see sharp drawdowns followed by recoveries.
Crypto's not had a great year at the moment. I don't know if you think we're in a crypto winter. I don't know where you think we go from here.
Yeah, so it hasn't had a great year, but I think it's important to zoom out, right? So if you look at the returns for Bitcoin relative to the day before the election in 24, Bitcoin's up about 26%, NASDAQ's up about 28%. If you look out, even further than that. 2 years, Bitcoin's doubled, Nasdaq's up 50%. So I think it's a little bit too myopic and a little bit too, call it, zoomed in to just talk about this year on an asset that's kind of run up that much over that period of time.
So if that's the case, where do you think we go? We have some folks on the technical side who say we can go lower from here.
Yeah.
Others who think there's a floor. Others who think we're going to the moon.
Yeah. So I'm not a technical investor. I'm a long-term investor. We're a VC fund, but I continue to see a strong and constructive 2026.
When you are you a Bitcoin guy? Are you an Ethereum guy? Are you a Solana guy? What's your
we invest
flavor?
Across the ecosystem. So we're venture capital.
Right.
We invest in everybody that's doing anything that's interesting in tokenized digital assets, crypto. We are large investors in Polymarket. We're large investors in a lot of stablecoin companies, but we're also investors in everything across, DeFi, the Ethereum ecosystem, Solana ecosystem. We're not what I would say ideological about crypto. What we are is investing in the future of innovation and financial markets.
Well, but what does that mean? I mean, in the context of where crypto itself goes.
Yeah, so I expect a good 2026, right? So for the token prices themselves, Bitcoin, Ethereum, there's likely to be continued momentum, I think, from a macroeconomic perspective. I think we'll have better monetary policy. And then we're going to have more and more adoption of tokenized assets. We're starting to hear it from the biggest asset managers in the world. McKinsey just said that they think 3% of all cross-border payments is happening in stablecoins right now. That's up from basically 0% a year ago. I expect another tenfold increase in that.
So within the world of crypto, if you could only do one thing, you'd invest in which part of it?
I'd invest in VC funds that invest in the, technical innovation.
That's not a fair answer. I'm saying in the specific side of, would you say to yourself, stable coins are the future? If that's true, for the public investor out there, would you invest in Circle? Do you think there's more competition coming?
There's definitely more competition coming.
Therefore, you wouldn't invest in. So what's?
Yeah, so stablecoins I think is here to stay. I think it's going to grow tenfold. I think prediction markets here to stay. I think they're going to grow tenfold. When you look at how you get exposure to that in the public markets, it's either call it the base layers, the Ethereums, the Bitcoins, or it's Circle or something like that.
You mentioned prediction markets.
Yep.
There is a question. By the way, it very well may grow tenfold. The question is whether there's going to ultimately be a lot of consolidation in this space, and whether you see a sort of confluence of the quote-unquote prediction markets and the sports betting books basically merge together, given the audience size that some of the sports betting books already have, and whether that makes more sense, or whether you think the prediction markets effectively overtake the success of the sports betting books. I don't think that's true just yet in terms of just the sheer number of people that are betting in the prediction markets is still small.
That's true, right?
And so the question is whether you think that there is a sort of mass market where everybody's going to be betting as much as the sports books or more. Sort of what does the TAM of that market look like? Total addressable market.
So I think it's humongous, right? So if you look
humongous meaning more than sports?
I think it's more than sports. Absolutely.
You do?
Right. So if you look at Polymarket volume today, they've gone from 50 million a month in early 24. They're now going to do probably about 4 billion of volume this month, right? Only about 35% of that is sports. Kalshi is a little bit different. It's more of a sports platform because they're infrastructure for Robinhood. But for Polymarket, it's about 35-40%.
Okay.
If you talk to Jeff Sprecher over at ICE, right, he'll tell you he believes in the tokenization of all markets. Like, he believes that is the future. I talked to him before he did the investment in Polymarket, and I can tell you that his perspective is that this is going to be as big as ICE itself, probably, right? I think when you start thinking about what are the use cases, okay, I talked to an insurance company maybe a month ago that was thinking about how they can hedge out risk in weather-related activities, right? That's just one use case in every single thing in every single market and every single outcome that can be put in a prediction market, or really just a binary option, which is what it is.
Tom Lee's outlook is fundamentally optimistic, but not naive. He sees a world where easing monetary policy, improving business confidence, sector rotation, and financial innovation combine to create meaningful opportunities across equities, financials, and digital assets. At the same time, he acknowledges risks, volatility, and the importance of avoiding complacency. The key takeaway is this: markets don't move in straight lines, but long-term innovation cycles, like AI and tokenization, can sustain growth longer than most expect. For investors willing to zoom out, stay diversified, and focus on fundamentals, 2026 could be far more interesting and rewarding than the headlines suggest.